Mic test, mic test. Good evening, everyone. Welcome to our Kenanga's first quarter 2026 Malaysian market outlook. And I'm glad that tonight you guys are joining us. I myself will be your moderator. You can call me Adrian. Some know me as Cap A. Uh, if you're curious, probably be on the tune in to us more to find out why. And tonight, we will have our head of research, Peter, with us, sharing his thought on how can we outmaneuver in this market. Good evening, Wendy Louis. Wendy is fine. Wendy Louis sounds so foreign, right? And after Peter's session in sharing with us on his view and outlook, and of course, the cream of the session is what stock to look at it seriously. It will be followed with Isabel's session. Isabel is our head of group equity marketing, which she's also our queen of warrants. If you do not know her, it's a good opportunity because tonight she's gonna guide you on how to maximize the tools that we have for you and also give a boost to your sweetener to what you can make. So, disclaimer before we proceed further, do print it out, read it. Disclaimer in my context is really something that I need to do. And myself, Peter, and Isabel are all licensed by SC, where Peter and myself is under the investment advisory licensing, where Isabel is with a dealer license. If you really want to know, it's module 12, 19, 6, and 7 that we need to go through, depending which you are looking at. All right. Without further ado, let me guide you through some of the slides that I normally share before I pass the floor to Peter. 2025, we have wrapped it up. Perfect. Awards. We will never be happy with the awards that we get because we will always want more. And why is that so? Because you guys are here tonight and most of the night. It's one of the biggest drive. And without dragging further, what I normally do in most of the session will be a quick reference of the field market, and then we will jump into Peter's session, the main highlight, and also where we can ask question. We can post questions to Peter to see on our queries, right? Dow Jones. At the beginning of the week, I've highlighted I'm highlighting on weaknesses where it have actually tried a new high here. And last night, I think the retracement has happened. Most of the tech stocks are seeing a strong retracement. Why did I say that? It's because of the divergence I've always been sharing on my Monday session, where you can see the oscillator is turning down. So be very, very careful on this, even though now it has formed a doji where it's trying to rebound. But this is where it's going to retest its zone. Catalyst wise, is there any? I think geopolitics is getting a bit more tricky and it's getting harder to navigate in the market. Hence, we want to be a bit more careful in the market. That's the gist of things. I will foresee that there'll be a bit more retracement. Hence, brace yourself, where the upside is still trying the psychological level of 50,000. In terms of Hang Seng, I started the week highlighting that I'm still very bullish that it's going to try to attempt to breach 27,000, and it did. Now where it is at this zone, is trying to keep above the psychological mark, but I think next week there could be a bit of a retracement that could happen. So I may shift my view a bit, depending on what happens next tomorrow, where it could come back to this zone before continuation. So you may want to look at the region between 26478 and also 27077. Now it's more or less there. What you can do is, if you're a trader, always log into Naga Matrix. That's the main website I always use because I want to track the tick sensitivity. If you do not know what is that, you can always check later because a Queen of Warrants will be guiding you through. Straits Time Index will be our neighbor. Singapore, they have did fantastically well. I did the very basic level one research on what is driving that. DBS, even UOB with a lot of loan book in Hong Kong has seen a revival in share price. Basically, a lot of the banks and property stocks like UOL and Hong Kong Land has also been anchoring it. They are also planning to pump the market. Hence, I think Singapore is a market that we shouldn't ignore. It's a good time to actually start reading about it. It's not too late. We can always be patient and wait for a bit of retracement. KLCI, this is what we signed up for tonight. We have reached a very happy level, especially Chinese New Year is coming. And this is where we can pose very difficult questions to Peter and ask what's going to happen and what's the target tonight. Gateway to Gold, USA and our Hong Kong campaign that is coming to an end this month. Grab the opportunity to win a gold bar from us. Hey, the terms and conditions are in the fine print. And DF Stretch is there. A campaign we have been running and it's going to end at the 28th of February. If you are a short-term trader within a week of a timeline, it's a very good tool to leverage on. Take charge of it. You get a T+7, yes. Do not need to close a position. This is a session I've been running on a weekly basis, 8:30 sharp, 8:31 if you like. But yeah, this is the link. Probably I will consider sharing it later, but do make some effort trying to print screen. KDI safe, 4% EAR. We might have something very exciting. I'm not too sure. It's a new year. We all have something in our pocket, right? Time in the market beats timing the market. Ken Fisher, quote of the day. And without further ado, shall I pass the floor to Peter? Sorry for
Hello.
taking 5 minutes. Good evening and Happy New Year.
Thank you, Captain. Happy New Year. Let me put my slides, yeah. Captain, can you please confirm that you're seeing my slides full screen?
Yes.
Okay, good.
Right.
Happy New Year, everyone. We meet again. Exciting to share that the 2026 is starting with so much horsepower, right? So this is looking very exciting. I'm not here to tell you exactly how things will pan out, but I hope I'll give you a good roadmap enough so that you are very aware what especially in my sessions what I could share, especially when I deal with fund managers on the institutional side, some feedback, what the funds are thinking, how people are positioning, what are the main questions that fund managers are asking, all those nuggets of sharing, I'm all here for you, right? As we started 2026, I've chosen a title as Outmaneuvering Volatility, specifically because moving into 2026, we know that it is possibly going to be choppy, but we are trying to utilize
We might have a technical problem. I seem to have lost Peter. Are you guys on the same page? All right, let me try to get to him. Hang in there with us. You guys are awesome. Hello, guys. Can you hear me? All right. Do hang tight with us. We are trying to troubleshoot what happened to the connection. And while we are at it, today is Peter's topic tonight, outmaneuvering volatility. So, unfortunately, I've not managed to join Peter on a roadshow with the Insties, but let's start with his slide. Would that be okay? While I'm trying to troubleshoot Peter's connection. Are you guys okay with that? In his view is that in the essence of how we started the year, the flow has been very constructive. Where most of the volatility is happening is an external factor, while domestically we have been strengthening. And where he do share a very strong view is that while we are experiencing a strong market here, we also want to try to keep an allocation of the dry powder, as dry powder, firepower. And in this context of the dry powder, why so? There'll be a slew of interesting IPOs that's coming online, probably your Sunway Medical and also your probably a buy sushi. I kind of like sushi. But yeah. So what are we looking out for in this first quarter is based on his research and the team's view is that we want to look for a very thematic and tactical place. And especially where another front where we can look at is the catch-up play and also potential mispricing sectors. Screening for asymmetries of the street recommendations and yeah. So hold on here. Okay. And rotational play. The banks have seen a very impressive run. There's something that we are dying to check with Peter later, as it is also going to be a front anchor of where the CI is going to be. Now we are all taking out notes, right? What to ask Peter later. So far, so good, right? My mind is working. Rebase expectation and roll up. Hence, hold on, give me a second.
Peter, you're all right there? If not, I'll try and save you.
Hello?
Well, whenever the year starts
Yeah.
badly, there's only upwards from now on, right?
Okay, sorry about that.
Welcome back.
Sorry,
Hey, no
Captain.
problem.
I'm
I'll
back
get
right
back to
now. Okay,
scooping
I'm back on
into
track.
that.
Sorry, guys. Captain, next page, please. I think. Sorry. Let's maintain this page. Sorry. Where did I leave off, Captain, just now? Can you let me know where to continue?
Yeah, just starting out. And technically you broke down on this page, but I
Okay,
tried
here,
to
right?
cover a bit. Yeah, you can start from here.
Okay. Okay, start from here. Yeah. Okay, sorry guys. First of all, we think that the first half will still be area to buy the market. We will stay invested and we will also buy on dips as we see that the most important thing is that there is going to be central banks liquidity support the market. We think that the three sources of volatility. Number one is geopolitics. and I will share how we can use it to our advantage. Number two is Bank of Japan. In the second quarter, we expect that there could be a little bit tumultuous when they decide or not whether on the pace of rate hikes in Japan. And thirdly, AI valuations. That is one area that we will demonstrate why it's important to watch for Malaysia. In terms of fundamental and allocation strategy, a lot of funds that I interact with are already quite well invested. So what it means is that investors need to look for rotation plays. They are going to switch from one sector to another sector or within the sector itself. And it also means that those names that are a bit more expensive right now, what will they do? They'll probably sell into strength. Why? Because they want to make sure that there's enough pipeline to go for IPOs that are coming up. In terms of thematics, we think that there is a way to look at laggards, but it's not buying every laggard, but we're looking for asymmetry, right? Some better risk reward, and I'll show you how. For sector rotation, one of the ones that we like is actually in the consumer space. We think that last year, 2025, was very strong for your SARA beneficiaries. But this year, where we are more careful, is that the valuations are a little bit high because as I'll show later, more than 75% of the market price improvement in the beneficiaries like EcoShop, 99 Speedmart, and also Nestle are all from valuations, and only about 20% is earnings upgrades. So we are a little bit more cautious. We also think that after 2025, when the tariffs was such a big issue, there is going to be a lot of earnings that is now already rebased. When I say rebased, what I mean is that analysts like myself has gone on to cut the market price, cut the earnings, for example. So the earnings are already rebased, even though the GDP figures don't really come out yet. So we are starting to see some areas bottoming out. For example, steel sectors, metals, and also to some extent oil and gas. And I shall share why. First quarter is going to be very busy for infra contract rollout. And that is something that we continue to watch for. I think at the moment, when we look at the sectors very quickly, last quarter we liked tech, we pushed very hard tech, and those who follow our advice probably made us a bit of money for the first month. This quarter we still have overweight tech, but we didn't actually call it a conviction sector because of some risk, and I shall share why later. Secondly, we like instead of tech, we like utilities now. So we put utilities as conviction together with banks, which is high conviction, and we also like RE and construction. We believe that on a bottom-up basis, we can get to 1,780, but as a top-down, we think we will get to 1,750. Now, our GDP looks a bit low. I understand that, 4.2. We think that exports will be a bit slow, but if we are wrong, that's where we would be wrong. And our GDP can be a bit higher. Our 7% earnings growth is for the KLCI, and 10% will be for the entire market. Next page. So on the next page, Adrian, where you will see, sorry, Adrian, can you please put the next page?
This will be the GDP, right?
The next page. Yeah, sorry, page 4, basically. Can you help me to put the page 4?
Yeah, it's there. It's a bit laggy. It's a bit laggy. It's not changing on my side.
Oh, okay, right.
Hold on.
Okay, so sorry for the
Would you want to
audience.
try to upload and see?
Okay, sorry, let me use my slides, okay? Okay, I think I'm stable right now, so I shall move to my slides, right? Okay, are you seeing my slides? Adrian? Are you seeing my slides, Adrian? Hello, are you seeing my slides? Hello? Hello. Sorry. Okay. I suspect you are seeing. Adrian. Sorry, I cannot get Adrian. Isabel, would you be able to tell me if are you seeing my slides?
Not just yet. I'm seeing the Teams
Ah,
chat, but
are
just
you
give
seeing my slides
Adrian.
now?
He's sorting it out for you.
Yeah. Yeah. I have put on share in terms of my slides. Do you see it?
Yeah. The liquidity ample. Can see that.
Thank you very much. Thank you very much. Okay, so this is our backstop in terms of the changes in the liquidity by this is central bank reserves. So as you can see, by 2025, the central banks are starting to expand their reserves, print money lah, right? So that's what's happening right now. So actually, we expect the Fed to cut 2 times earlier than market. We expect it in March and June. So that's going to be a first half going to underpin or anchor some of the good liquidity for the first half. We think that it's not going to be one-way street. We think that there's going to be some areas of volatility. I think right now what we are saying here is that if the yen hits about the 145 level, that's where in the past we have seen, this is a volatility chart, right? The volatility down there in the red lines, those are actually where the volatility is high, corresponding with yen coming to about 140. So we will watch for that. That usually will happen in the second quarter of the year. So we don't really have to worry about that yet. I've got a very nice chart for you guys. In fact, this is a chart to talk about geopolitics. I'm not sure whether you've seen anything like this before, but essentially, when the geopolitics over here, and we map against something called Fed economists have come up with a geopolitics index. When the politics events is one that threatens to become more spillover or at the brink of war, like US Iraq or September 11, we did see that the volatility in the market, as represented by this chart called index called the VIX, right, which measures volatility, it normally shoots up to more than 30. But if the issue is actually quite contained in that the geopolitics can be will not spread, or the market doesn't expect it to spread, we believe that the index normally will be 25 or below, right, around 20. What we are saying, why is this important, is because we believe that in an environment whereby the volatility is not extremely high, we don't really have to run for the hills, meaning to say that we won't have to pursue a defensive strategy. But more importantly, what we will say is that it is unlikely to be suitable for a swing trade sort of environment, not like last year taco, right? But we think that this year is a buy on dip sort of strategy. So that's why we want to study the pattern. If geopolitics become even more severe, is Malaysia a good place to hide? The answer is a resounding yes. FBM KLCI has always, in those attacks on geopolitics, beat ASEAN in the past for most of the time. And the drawdown on the 1 week and 1 month post the events tend to be relatively shallow. So we are not extremely worried in that sense. I think what we will say is when we look at the when US prints money, right? Like some sort of like expanding the balance sheet of the Fed. In the past, when the last time they did it was 2019, they call it a technical QE. We saw that actually come into our bonds market. We also saw some outflow in equities. Today, we argue that the equities is more attractive to the bonds by about 40 bips, 0.4 percentage points. And that comes from the fact that when we look at the earnings yield of the KLCI versus the 10-year MGS, for example, 3.3 minus 2.9%, we have about 40 bips of a buffer. So in that sense, what we are saying is that, there is higher chance this time around that if the US prints more money or expands its balance sheet, that is when money could be flowing into Malaysia equities rather than only into Malaysia bonds lah. So moving on from there, I think has been a lot said about outflow, right, in terms of Malaysia market. But if one was to look at certain sectors, like on the right chart, I've shown the foreign shareholding of in here Maybank and RHB. So certain sectors like banks continue to see good for shareholding improvement, and these two, especially with high dividends, they have managed to go to a multi-year high sort of levels in terms of foreign shareholding. So it's not true that they are not coming to the market, but it's still quite selective. And let me explain to you why we believe that banks is a high conviction pick. If you think if and agree with Kenanga, what we are saying is that we believe next year we are going to have a OPR that is going to be unchanged, right? We think that as the OPR will stay at 275, but we think that the 10-year MGS that is going to come off a bit. So when usually when the bond yield come off a bit, what it means is the banks make money from their non-interest income, right? When they revaluate, when there's revaluation of their investments in bonds, that tends to be a pickup in their NOII, and at the same time, our net interest margin is more stable than other countries. For that reason, it could be a best of both worlds scenario for Malaysia banks. I think just another chart on volatility. We believe right now that when we look at the AI spending, there's a little bit of putting the cart in front of the horse. On the right chart, you will see that hyperscalers, when we take the capex guided versus their revenue expectation, it is still going up. So why does this matter? Because when we look at Malaysia tech industry, whilst it's so small, we are wrong to compare it to, let's say, the Nasdaq, we still see a very good correlation in terms of how it trades, right? So you can see the green and red charts actually very closely similar. So what we are thinking over here is that if there is a chance that the valuation sort of comes off a bit, we are not surprised if that will also happen to the Malaysian sectors. Okay, so we have spoken about flows, but how about fundamentals, right? So on fundamentals basis, on the left side here is PE, and on the right side here is earnings. So any dot over here that is more towards the right, technically is for the same PE is more attractive. That's why we justify construction, we prefer more than property, for example. That's why we still like tech, for example. And that's also why we are able to justify why we like renewable energy. Although it trades 30 times PE, they are still growing at about 26 times percent in earnings, right? So there is a price to pay, but we think it is reasonable. However, just looking at a point in time chart like this doesn't really give a lot of confidence to us, right? Whether the more important thing is, can we look also at how the street or Bloomberg analyst contribution have adjusted their earnings expectation for 2025 and 2026. What we have known is that over the past year, some of the sectors actually saw earnings upgrades. So those of you who own planter stocks, you have done well because earnings have been upgraded. Property likewise, and also construction to some extent has been upgraded. But to make money, we need to look at what has already been sort of like rebased or bottomed out. So over here, oil and gas on the left side of the spectrum, you will see already quite hit in that sense with 2 years of more than 40% cut. So when we look at the earnings rebase, also we ask how about some of the catalysts that can bring it higher, right? So let's say we have heard so much about China, about their catalysts being a bit slow. You can see over here that China fixed asset investments, and the red line is actually chemicals, for example. Their cumulative growth rate has actually already grown negative. So if you guys have heard of the term anti-involution, where they are trying to increase the prices and not just the quantity of materials produced. This is one of the evidence that it is working. And you can see on the right chart that capacity utilization is also improving. So what we are saying here is this will dovetail very nicely with some of the earnings rebates that we have seen previously. And therefore, oil and gas is one area that we are looking at. Steel sector is one we are looking at. Chemicals, we think that there will be a contrarian view that we think will work in 2026 as well. Now, some of my broker colleagues, peers have asked to buy the laggards. We think that is true, but with a slight caveat. If I look at all the KLCI stocks, and this chart is about 1 week old, the stocks that have been, I would say, underperforming, the rate is actually the so-called share price decline last year. And the reality is not all declines are the same. Some of the declines were actually earnings cuts, and some of the declines are due to multiple changes. So if you can think about re-rating potential, actually what we are really looking at more carefully is whether it was just due to valuation compression. And when there is a re-rating, when the market is more hot, that sort of multiple will expand again, right? And it's not about, and for those reasons, those that experience multiple compression, we think are the ones that will probably have a re-rating, rather than those that we saw earnings cut, like YTL Power had heavy earnings cuts, right? So we think KLK, QL and Mr. DIY where recently Mr. DIY have started to re-rate also. So those are some of the laggard stocks that we consider. Now, this chart, I'll just leave it here so that when you look again at this presentation, you can see how the analysts are trying to position themselves. But when on the right axis, x-axis, is the analysts with buy call. So any towards the right, it means the more analysts like the stock, right? And towards the left is actually consensus upside. I thought it was useful for me to do this chart for your viewing pleasure. There are some stocks that at the moment all the analysts have buy, but the upside is quite low, which I boxed up on the right. But at the same time, there is also stocks that less than 50% of analysts say buy. So it's not a consensus buy, it's a consensus hold, but the upside is already more than 10%. So you can see all this upside based on analysts' aggregate median expectation. So this is just a stock for some of you to so-called look at some stock picks ideas. So that is how I look at laggards and mispricing. Now, looking at another theme that we like, the SARA beneficiary last year, those who have exposure to consumer, we want to just show you how the consumer share price has actually rocketed up and break it down by earnings and multiple expansion. So when you look at the ones that has been bracketed in red for SARA 1 and SARA 2.0, Nestle, 99, EcoShop, we see that the multiple expansion is about 6 to 7 times and followed by another 3 to 4 times in SARA 1 and SARA 2. What it means is that only 20 to 25% of market cap changes is due to earnings upgrades. All of it is just because of additional confidence in the multiple. So one key thing to note is that all the other stocks like Mr. DIY over here, QL, F&N, to some extent, they have not actually benefited as much in terms of the multiple expansion. So we think that after the SARA post-February, when the euphoria dies down a bit, there will be rotation back into laggards, for example, Aeon. So for 2026, we think that is a better way to position for the market. Now, everyone talks about Visit Malaysia here. Let me show you the numbers. The first thing, we can't always take our government targets. So government is wrong almost half the time if you look at our top chart. We think at the moment, the ringgit strength is going to come into play when it comes to tourism. We still think that 2026, we will likely see a 10% increase in tourist arrivals and get to 30 million tourists. That is lower than government's 35 million. In the previous Visit Malaysia year, how did things fare? We noted that down here is the on the bottom right is the revenue growth. And we saw the beverage names all do very well. FNN, Power Root, Spritzer. We don't expect any changes this time around. So we like to play through FNN, Life Water, Spritzer example. So those are our main push for the Visit Malaysia year. We can also go through medical tourism. The one with higher exposure this year is IHH, where 15% of its current exposures is in this space. This is a structural space, meaning to say if you like the story on an angle, it is going to give you a long-term run because the growth of medical tourism is simply ballistic at about 28% growth CAGR for the next 5 years for our industry. I think just on the quarter, I will quickly go into sectors. We are more for our followers that come to our webinar. We just want to show you quarter on quarter. We are more bullish on banks. We are more bullish on consumer as well because we believe that our 10-year yield will come off, right? And when yield come off, rental names like REITs will usually do a little bit better. So we think that the compression play for REITs is there at the moment. Steel and oil and gas, for steel, we think it's already a good entry point. For oil and gas, we expect that it's something that we are monitor for re-rating soon. On the more bearish side, I'll highlight on tech shortly. On the auto TIV, we expect 725,000 from this year, closing about 800,000. We have a contrarian buy on B Auto, maybe one of the only analysts on the street that likes B Auto right now. And on healthcare and building mat, healthcare, we think certain areas are quite expensive. We will be more careful. For building mat, right now, it is more of a valuation downgrade because we think press metal is a bit expensive for our liking. Okay, these are our picks by sector. However, we think what is also interesting is when outside of looking at by sector, what is actually our top recommendations? This is how we look at it. We think that on the key pick side, I'll quickly explain a bit before I go into the sector specific. We like a combination of M-Bank. We like a bank. We also like Muda for construction. We like Kenanga. We like for tech. We like some of it on the wafer front end, which is Kellington and also UWC. We like on the smaller cap side, B Auto is our contrarian shout. And we like KGTS and CS SolarVest. Honorable mentions that is we like Paramount. Paramount we recently initiated. It's a property company that is starting to move into northern part of Peninsular Malaysia and Penang. And most importantly, it gives you an 8% yield. So it has visibility and and right now at current prices, it might even go up close to 10% yield. OCK is a name that investors usually look at it. Earnings not really great in terms of delivery, but they are in the right place to benefit most from network 2 telco rollout. The third one that I would like to highlight is SKP Resources. If you look at the share, it's starting to move up a bit. What we think is that previously investors were too worried that one of its major customers were going to move all their EMS volumes to Philippines. That has actually not happened. The only reason right now we also went to check with the likes of VS Industries, looking at SKP Resources. I think one of their major clients are still going to tender out new jobs in first quarter. So we are quite comfortable to push, although there is slight concern by fund managers to say that it is exposed to ringgit strengthening. Encom is one that we have waited for very long. 2025, we never banged the table, but now is the time because they are a herbicide player, and right now they're in Brazil. Previously, the herbicide was only used in sugarcane. Right now, the Brazil have green lighted soybean, and soybean plantable area is 5 times that of sugarcane. Sugarcane currently for Ancom they have about half market share. So when we let that only you can let your imagination run wild a bit, but essentially they are there to be able to take market share for soya bean in Brazil. Where we are contrarian is in a few stocks, CIMB, RHB, we have a hold for that. We think press metal is a little bit expensive. And PCAM, we still think that in 2026 is where we are anticipating our thesis to materialize, in that we should be able to see some coming off of supply on a temporary basis, and that alone will be enough to push up ASPs and the share price higher. So I'll just pick a few sectors to present, Captain A, if that is fine. I think the last quarter, we actually upgraded tech. So this quarter, we are not so gung-ho, and maybe that needs to just have an explanation, right? So let me just start off with this a slide on tech. Basically, on the two stocks that we like UWC and Kellington, which is exposed to wafer front end. We think that ex-China, currently what we have seen is despite a lot of high fab announcements, the level of actual equipment spending for the fab is only back to 23 levels and not even back to 20. And in 2025, it has only gone back to 2023 levels, as you can see in the blue and green. So what it means is that usually every 100 billion worth of investment in fab, there'll be about 8 billion spending in wafer front end. So what it means to us is that the recovery of the spending in wafer front end is still lagging the announcements. So names such as Kellington, UWC will have some ways to go, is what we are saying. But otherwise, we are a little bit mindful about the AI valuations at the moment, where there is a lot of funding each other through equity in the US. We are also a bit concerned about the memory currently that is being so dominated by AI and data center spending, that the more bread and butter sort of memory right now, there's a bit of a shortage. So your iPhones, your consumer products will become more expensive, for example. And we also know that the Nexperia incident, whereby some of these chips that go into auto supply chain, automobiles, they control a lot, about 40% of some of the more basic chips. So for those reasons, some of your car companies are also likely to suffer some temporary shortages. So for those reasons, we are more careful about tech. I would like to take a minute to explain utilities. I'm mindful to stop within the next 10 minutes. So in utilities, we like Kenanga. At the moment, we feel that the investing community is trying to gauge and validate where YTL Power's earnings will be in by May quarter. That is why we think that at the moment, the better risk reward among the big caps is actually Kenanga, because market is looking that for by February, and you hold it till February, where it will re-rate is probably when there is confidence that despite the tax issues that it has gone through, they will continue to pay that up to 60% sort of dividend payout ratio. For YTL Power, right now, the market in the last briefing call already had information that some amount of its low-cost gas inputs are likely to expire by the financial year end. So I think the market just wants to validate the expectations first before biting very strongly. Although at this price, it already looks cheap. Of course, right now the market is expecting and somewhat a bit delayed is the award of 6 to 8 gigawatts of new power plant capacity. We know that by 2030, we desperately need the power. So right now, assuming the 6 to 8 gigawatts, normally one power plant is 2 times 700 megawatt turbine. So you should be looking at anywhere between 4 to 5 awards, and it will be enough to go for Kenanga, for Malakoff, for YTL Power, and even unlisted Edra Energy. But what we are saying over here is some of these players, like Malakoff, they have come out to say that they have turbines, and therefore they will have the likelihood of getting the jobs more. YTL Power have also said they have the turbines immediately because there's a backlog for turbines at the moment for about more than 1 year. Therefore, this is quite important thing to note. Just wanted to highlight that for the utilities, there's also regasification terminals. 3 out for grabs. 1 has already been awarded to Pet Gas. We understand Gas Malaysia has also thrown their hat into the ring to get these regasification terminals. So there are a lot of opportunities for rollout pretty soon. Now, in another area that I want to highlight in terms of construction is currently our view on construction is we still like to think that in 2026 the amount of total project awards in the sector continue to be more than 180 billion, and that is going to be sufficient to be matching from the year before, i.e. 2025. So when the pie is still very large, there is no reason for the valuation multiples to come off. We think that the play is still alive. However, at this moment, given what is happening on IGM side, if you believe that the IGM deal will go through, if the large shareholders, especially the Glicks, agree for it, then our pecking order is Gamuda. And then we think that it could be bearish for Suncon, but more bullish for IGM eventually. If, for example, Sunway were to take over IJM and keep both listed, right? You got IJM, you got Suncon. We think it could be slightly bearish for Suncon because Suncon is trading at much higher multiples of high 20s versus IJM right now, which is close to 18, 19 times. So there could be some narrowing of the gap between the two if there is a chance that you believe that it will go through. So far for our advice on IJM, we think that the idea here, if you are only an IGM shareholder, is to reject the deal because you are essentially swapping a undervalued stock in our view for an overvalued stock in our view. But if Kenanga is wrong, and the deal goes through and most investors follow the Sunway, what will they stand to gain? They will probably stand to gain about 7 to 12% improvement in TP post the merger, where we think the easiest way for Sunway to gain some form of improvement is in the property portfolio, where Sunway should be able to improve the IJM's value extraction from their large land bank. So we think it's about a 60-cent improvement to target price for Sunway if they pull this through. Right, so just wanted to mention this. In the properties, I will end with maybe a couple of sectors. At the moment, we have gone through I would just quickly want to talk about auto as well. In the auto sector, we are contrarian in saying that we like B auto. What we are thinking, how we think about this is that B auto has a segment called Kia right now, where they are no longer going to the distributorship in 2 years' time. That segment currently is a 20% drag to their earnings, about 12 million drag. So if they stop doing it, just by stopping the doing it, they will actually save 20% on their bottom line. And on top of that, this year, if you follow the auto side, country wants to implement something called open market value to calculate tax on vehicles. This is going to affect those vehicles that are CKD or made in Malaysia, right? But Mazda's business, for example, under B Auto is currently they are more exposed to CBU, so they also won't be affected by this as well. So that is why we like this space. Finally, I think I will just close with plantations. I think a lot from my experience, I think a lot of investors like the plantation space. Let me just explain how we look at it at the moment. we think that right now the potential for 2026 earnings to be flat or slightly lower is there. We think that 2026 will be about 4,000 on average of CPO price. That is probably slightly lower than the street, but I think as far as the starting of the year has to go, we think that we are on the right side of the view. If you have seen just 2 days ago, Indonesia has said that they will not proceed immediately with B50 blending of biodiesel. In that uh, uh, that is one area that will probably lower a bit the interest in palm oil prices. Of course, we still like some of the areas like in within palm oil itself. We like integrated names. So KLK is one name that we like, despite the street mainly preferring some Dabi Gatri. We think that for PPB is another name that we also like. We think some of its issues with regards legal has already been done previously, and right now within the small cap, I think we like Upsing Plantation, although we think consensus earnings are too high, so we think it's safer to advise go for TSH, given that TSH has very strong upstream new palm oil planted profile in the next 3 to 5 years on a structural basis. I think I speed ran through some of these sectors also because partly I felt I wasted audience time in the early part of the presentation, but now I pass the time back to Adrian for more questions. Okay, over to you, Adrian. Sorry, Adrian, can you hear me? Isabel, sorry, is Adrian there?
I'm back. Hi, can you guys hear me?
Hello.
Wow, thanks, Peter, and thanks, guys, for riding through us these technical challenges and stuff, right? So without further ado, right, if you have burning questions, you can actually put it into the chat box like here. I'm saying hi here. But before I proceed with questions that I have been wanting to ask Peter on, I would like to take the opportunity to congrats Peter on, especially on the B Auto upgrade and pick, because at that timing where our research has made the call, it has rallied for more than 30%. Today is about 8:05 or 8:30 something. Fantastic. And coming back to the floor, do you guys have any question, or I'm gonna start mine? Hello.
Hello, yeah, I'm here.
Okay, so since everyone is a bit shy tonight, or rather reeling from the shock of the technical errors, let me get the ball rolling. So for Peter, when we look into the laggards like the names of oil and gas, uh, I definitely concur with the view in the oil and gas field, but on top of your mind, which would be the first that we want to look at or hunt for? Because clearly in the OSV segment, there's a bit of a valuation or price movement gap versus key field and also the one that's listed in Singapore.
Yeah, you're exactly right. I think right now Keyfield is definitely one of the names that we're looking for or monitoring. You see over here, actually right now, even if you go by what the street is recommending, there's a 20% upside, although it may not look immediately apparent that the street likes it, right? Because only over here, in terms of percentage of analysts with a buy call, only 30%. But we already know that there's some value already there coming up. We think that for Keyfield, the main reason for them that they will come up faster from a recovery is also the fact that their vessels are relatively new, right? So when you have got young vessels, for example, those normally command better rates, and they should be able to come up from any down cycle faster. So for that reason, on the recovery, on the way up, we will be monitoring closely Keyfield as one of the plays.
Yeah, because the way I observe the several markets where Nam Chong in Singapore has performed really, really well, and they do have a fleet. So I was wondering if our Malaysian our Malaysian investors and also perspective, would they have been missing something out in that context? But I guess, yeah.
Right. I see. Yeah. Well, and your angle comes from?
Nam Chong has performed extremely well while they are
Right.
also OSV fleet owners. Lah. So I'm wondering between our neighbors and Nam Chong is also a Malaysian-owned company where the parent company is CCK. So was wondering in that field where OSV do pique my interest. But of course, if I recall properly, that dialogue was also one of our topic, right?
Yeah. In fact, the way that we think about dialogue is currently the if I may just explain a bit, oil and gas peak of PCAM may seem a little bit aggressive because there's a structural a lot of capacity, but we think that within 2026 some of this capacity could come off a bit in terms of supply. So for that reason, we are seeing that there could be some improvement. However, we like to think that there is a bit of a barbell strategy thinking, whereby PCAM is more of the more aggressive name, and Dialog is the one that is going to be more defensive, particularly from its EPCC side, where we think that its troubles are behind it. So right now, EPCC is either going to be break even or slightly better than break even. We also think that at the moment, if there is going to be more OPEC, more oil, more quantity, that this is going to be an area of storage that they will continue to benefit from as well. So they are a little bit more defensive as to pair with our PCAM more aggressive view. Yeah.
It's like finding the right balance when we are dealing in the sector, right? It's
Yes,
just a
correct,
good.
correct.
I that's a very smart way to do that. So seems like our floor has warmed up, and we have a question from
Let's
Brandon.
go. Yeah.
You mentioned about UWC and what is your thought about Great Tech? I think probably because Great Tech rallied today. Is that correct, Brandon? Yeah, quite savvy, man.
Yeah, I haven't actually had the time to look at today's rally. I think for UWC, we still think we still like its if you are talking about potential upside from here between the two, we still have confidence in UWC. I know UWC has already done pretty well, right? In the past 1-2 is it about a week or so? It continued to move up. Today is about 455. Our sensitivity currently shows us that when we look at some of its business, when you look when you know they do tester equipment, right, for the back end side, currently if they were to they are currently being in the stage of whereby some of its main customers could actually give them more work, in our opinion, from what our channel checks. And let's say if they were to increase their current work on the testers by about 20% from one of these customers, our share price sensitivity in terms of target price will go up by another 40 cents. So our share price, right, the target price right now for UWC is 432. We will on that count, we probably reach about the 480 levels. And this is not to say that we have given even very aggressive on our valuations. In fact, we are pricing it at one standard deviation below its average. If we were to just to go to average of about 30 over times, our share price goes up to already around 520, 530, inclusive of the additional testers that we could come in, right? So I guess what I'm trying to say here is not about talking about Great Tech in specific, but within that space, we think some of the names like UWC, which we like quite well, still have legs to run. Adrian, if that helps, because I'm sorry, I haven't had a chance to look at why Great Tech ran today. Yeah.
Okay, Ken, that is a great insight on the potential on UWC. And sorry, Brandon, we couldn't do much for you on Great Tech, but if you follow us close enough, I might be able to find an answer for you next Monday if you follow us close enough. So the next question will be Akmal from Akmal. Do you think that TSH can afford to pay more dividends going forward? Also, it owns a substantial stake in No.
Uh, I think right now, in terms of TSH being able to pay us more dividends, is not an angle that we like at the moment. And we think that angle that we are coming from is definitely more towards the area of new plantations. So we think that the new planting area is one that we like a lot more. Although we by itself TSH dividends is already pretty decent in my mind. I can quickly check shortly what today's yields are. But we are thinking about it as a sustainable yield rather than a yield grower
Mm.
stock in that view. I suspect the just give me a second. I can check the yield in a bit. Adrian, yeah, I'll come back to you.
No worries on that. So let's take some question from the Q&A box, starting from BK Tan. Any reason why Gamuda price retraced so much today? Hmm.
Oh, okay, yeah. I think I think fundamentally on the stock there is no negative news that I've heard. In that we know that the discussions on data centers with some of the big hyperscalers are still happening. So on a fundamental basis, there is probably no reason that the stock would derate. I suspect this could be some maybe shareholders selling, etc. But that is that would be normal course of action. But put simply, I also think that there could have been a little bit of interest moving into IGM even before the Sunway deal was announced, because IGM was already battered down quite a fair bit, where it rose from about 220 to about 240, and then later, a bit higher. So I think there was originally already some rotation into the laggard, and I would see that a price decline as a reason to pick up, especially given that there is no fundamental reason why it shouldn't do well. If you think about valuations, IGM currently trades at about 18 times PE, and Gamuda, as of yesterday, before today's drop, was 19 times on FY26 earnings based on streets. So you can almost make the conclusion that Gamuda and IGM are already at that so-called same level of valuations even as of yesterday. So I would consider a fall today to probably be a reason to pick up the share price.
And Peter, I think I totally agree with you. Do you know why? Somehow, for very odd reason that I've observed, when we tend to run our webinar, it's always giving an opportunity for a lot of followers to relook at our picks that normally is at the lower end. And subsequently, it rallied. So
Yeah.
looking at the chart today, even I've checked through Gamuda, I think the next support range is about 456, which is looking pretty strong in that sense. Yeah.
Thank you, Adrian. Thank you very much. You
Okay,
do.
from
Yeah.
CC. What's the main reason do you think metal will recover this year?
Yeah. Number one is just I think in terms of the steel names that we cover, such as Intech, such as Ulicorp, for example, what has really been an issue for them previously was number one, inventory prices that was unfavorable. So that caused some of the earnings pressure, especially in Intex. Right now, we know that the in when we look at the existing operations, that is something already in the past. So some of these inventory stock issues are already being ironed out. Number one. Number two, when we look at the industry as a whole, we think that at this juncture, there is going to be, when we look at earlier, right, when we look at the area of stimulus, what we are saying is we expect that the stimulus from China that will continue to happen, albeit in a right now seems to be quite a slow fashion. We think that one of the charts that I was showing earlier, if I may just go back, we think right now that the utilization of China manufacturing capacity that's also improving. So that is going to be one of the leading indicators of demand, and usually that will then bring up some of these commodities slash metals prices, in my opinion. But this is of course a more macro view on the sector. Yeah.
All right, Madam Louis. I always love your questions, Madam Louis. And why? Because you always ask the tough question. So this tough question coming from Madam Louis is, Peter, do you think the healthcare hospital sector is ahead of their fundamentals in terms of their valuation?
Okay, okay. Well, I'm going to show you something that we look at the moment. In terms of healthcare, I'll just look at this IGM Sunway study. Currently, the way we look at healthcare is when in our numbers, and we are a bit behind the curve in terms of the target price. Yeah, consensus target price for Sunway currently is at 5 ringgit and 70 cent for my last check. Within there, the main difference is healthcare. In our numbers, healthcare, we value it on 20 times EV/EBITDA for Sunway Healthcare. And to give you some perspective, KBJ is around 13 times. IHH in the Malaysia business, internally, we value at 15 times. So for this healthcare, we are already giving some premium, despite them only having 5 hospitals. So on 20 times EV/EBITDA, we think that the figure here is 9.7B, but it's 84% for Sunway owning Sunway Healthcare. So what we are saying, Madam, is that we think that 12 to 13 billion valuation is most ideal, but what the market is pricing in now for the valuation of Sunway Healthcare is probably 16 billion or more, right? And that equates to close to 23 to 25 times EV/EBITDA, which is a huge premium over your IHH and Malaysia and KPJ. For that reason, we think that maybe the idea here is they have a very aggressive goal of doubling beds by 2032. So I think the market will give initially some benefit of the doubt for the Sunway brand to pull it through, but I would also caution that it is going to be highly susceptible to execution risk or policy risk, right? If there's suddenly some change in guidelines, that could actually crumble the valuation, and it could be quite fast. So I wouldn't say that it's overvalued, but it's also priced to quite perfection, whereby it cannot take too much of an earnings disappointment on the healthcare side. If Kenanga was to use, let's say, 16 billion sort of valuation, our target price for Sunway would be closer to 530, 540. Inherently, we don't think Sunway is a very good name to own at the moment, although from my casual conversations with fund managers, the likelihood of it derating is also not very high at the, for now. Yeah.
16 billion market cap valuation for Sunway Healthcare is closer to 26 times EV/EBITDA, and that is perfection. That is perfection. I mean,
yeah, it sounds a bit high, but obviously I can only speak for myself, but I just wanted to be transparent that is how we look at the deal. I think right now the Sunway Healthcare IPO is ongoing. I do note that we Kenanga, we are not part of the joint book runners. So what we are unable to give you a value per se, but we do already have it within our Sunway per heart valuation. Currently, we have it at about 12. I would say that when we roll over our EV/EBITDA maybe to 2027, we will come closer to 13, 14 is our best estimate now.
All right. So, well, I will take one more question from the Q&A box before I move back into the chat. From Ray. Oh, this is a ray of light, right? What mid and small cap stock tied to data center team that haven't seen their valuation cash up play yet? This is a very interesting question that I've been wanting to ask, but you got it to me
Okay.
first.
Okay. I think on the if you ask me personally, one of the names that we don't cover, but if you're asking me the data center names that potentially have some catch up potential, I'm literally checking my phone for what is the price today, right? I would say Kawan Energy is one of the areas that I'm looking at. Simply because I feel that this name is one that currently is trying to help data centers, especially in areas where currently we know that the burden on the grid on getting power is already relatively strained on some areas, let's say in very hotspots of data centers. So what they are also trying to do is to on off the grid level also be able to supply through a virtual LNG line, essentially using the mobile truck, right, to go to the site and using a cogen plant to be able to help some of these data centers get power. And the reason why this happens is because some of the infrastructure that is required to be built by Kenanga hasn't been delivered to the data centers yet. So the data centers might just say yes, right? If I got another alternative power source before the Tenaga facilities actually come up and running, I might be able to engage some companies like Kawan Energy who is exposed to this area of a cogen plant. So that's one name that I think looks interesting to me, although I don't have coverage over the stock immediately. I think that is one of the names that immediately jump to mind at the moment, Adrian. Yeah.
That's an interesting name, and looking at the chart, seems like we can look for an opportunity very soon. Just to give you a context, the support zone is 57.5. Looking at the chat box, right, we have this question from OSK. You sure you're not competitor, right? Looking at NETR, SolarWest aside, what's your take on the potential broadening out of work from Malakoff? I think probably from OSK's question is, what is the spillover impact from this turbine play, power plant play, or smaller contractors, or even supply chain perspective?
In terms of the NETR spillover play, right? I think at the moment, did he mention Malakoff? Sorry, Adrian, did he say that?
Yeah,
Sorry,
from Tenaga and Malakoff.
Oh, okay. From
Jobs from
Tenaga. Okay, right. I think currently, when we look at the spillover into the other spaces, at the moment we think obviously there is still a lot of activity on the power demand office and this naturally came from data centers, right? That is causing them to have to build all this infrastructure, number one. When we earlier in my utilities presentation, I mentioned even on the power plant side, we are expecting some to come up, even regasification terminals, right, to support that. So I guess that is one way that you can say it is a spillover. So that's PET Gas, and Gas Malaysia is also putting its hat into the ring. Number two, obviously when it comes to the on the ground. Therefore, we have names like names that we don't cover, MN Holdings, Cheating, which we also haven't yet covered. And I hope we do more work on that. And then of course on this and Powerwell, for example, right, that does the work within the data center itself on switchboards, etc., etc. So obviously, that is one area that will continue to structurally grow. And you mentioned aside renewable energy, so I will not specifically talk about solar VAS, but we think that the when we look at the current rollout of the likelihood, if I was to make a educated guess, currently we might see that there will be more players coming into the space. What I'm saying is, instead of just a few players getting 300 megawatt, 500 megawatt sort of large solar plants, what the industry is talking about right now is, as the marketplace becomes a little bit more constrained in terms of actual grid infrastructure. The question is, should we build huge solar plants, right? Or can we do many small ones? So I think right now the opportunity is not concentrated so much in just a few big players, but it's going to be even more spread out, right? So I think that is something to look at, where you can buy more, get exposure to more names. And then one of the things that maybe to answer the question in more holistically, increasingly there will be more place on the battery side, right? Because battery right now is a requirement when it comes to even likes of LSS6, when the bits do come out. As we understand, it will include battery. So currently, I think one of the names that are listed is under this company called SEAL, SEAL. So SEAL is one of the companies that are doing the battery. But other than that, all the other names, even like the likes of your Gamuda and all that, are also in the battery name. So I think this year is one that we will see more interest, especially on the battery space. SEAL is a subsidiary of MGRE. Yeah, so the listed code is called MGRE.
All right, thanks, Peter, on the power side. We have last two questions, and today we will work over time a bit, thanks to sorry for the technical error. So we tambah 5 to 10 minutes, yeah?
No problem, please, thanks.
One question from Zeng Tao. What's your view on Netgate, which the share price have dropped very significantly? I think today there's a bit of a rebound, but let's dive into it.
Yeah. I think the way that Kenanga looks at Netgate is what we have. Remember a couple of years ago, they got NVIDIA, where they assembled the servers, and then of course they sell and then because of NVIDIA and AI, the share price went up, I think, to 3 ringgit or somewhere close to there. Then after that, obviously, given the crackdown on potential exposure to Chinese on an indirect basis, share price derated. So today, the way Kenanga looks at it, in our target price, we no longer ascribe it any AI additional valuations. So we have gone back to even pre-AI valuations of about that high teen sort of valuations. And even then, we think Netgate is undervalued, right? So we, first of all, we already removed the valuation a premium from the AI. And what now really is happening is as one area that is maybe less appreciated is, now that the AI and data center build out has been done, and this also has a little bit of correlation to the question by the earlier person or gentleman or lady, is that there will be a lot more need for CPU. Right. So right now Netgate is trying to capitalize on that CPU layer as well. So I think that is one area that you can call it like a spillover effect of data centers. Like the second layer right now, people are spending on the CPU, the storage, rather than spending on the AI server level itself. So I think that is one area that the CPU business is probably a bit underappreciated. So we got CPU coming up. we got valuations that no longer trade with any AI premium, so we actually still like Netgate lah. Obviously, also related to the earlier question on NETR and data center, the next layer from AI build up is to look at application and software lah. So expect Kenanga to have more work done this year on that layer and those type of companies as well.
That sounds really exciting. You're keeping me on a tight leash, Peter. I can't wait to see what's the next initiation.
Exactly, right? Yeah, exactly. I can't let everything out of the bag tonight. I want the everyone to come again for the next quarter, right? Yeah.
Yep. All right. Probably the last question from Mel. What's your view on pawn shop shares? Well-chip Papa Jack EMCC. This is the pawn shop and not the pawn shop. You get what I mean, right?
For pawn shop, yes. Yeah, we have done on the radar like a non-rated note on well chip. Obviously, the thinking here is whether or not it makes it a good proxy play to gold price, right? So in our assessment, usually for the pawn shop, the increased gold price is usually going to improve their ability, obviously, to give up more loans as a collateral. However, we think that at this juncture, I don't have I might have to come back to you, Adrian. I'll share with you the latest thoughts. But right now, if we just were to look at precious metals, our central view as Kenanga is the dollar is going to strengthen a bit in the first quarter first. We think that that strengthening in the first quarter before it sort of comes off again will mean that in the near term, we think that any sort of like proxy play to gold, I may not be that attracted at the moment. But that is more of a macro view, Adrian. But on well chip, we all know that what was the issue previously, for example, right? Some of these were related to the number of pawn shops that they were allowed to open. And subsequently, obviously, they started to make good on their promises by opening at least, I think, in their pipeline, 5 to 7 pawn shops. That is more on the bottom-up basis where their earnings are growing from the additional footprint and not actually a proxy to the gold price. So on a structural basis, that is also one name that we actually like.
Interesting. I'm always intrigued with pawn shops. Yeah, I pronounce it right. Correct.
Yeah. I think there's always a two-way to look at it. Whether you want to play the likes of like Gold Jewelers, Tome, or Pokong, or on the other hand, you want to go for a so-called a proxy towards owning like pawn shop exposure, right? Of course, on the one hand, on the jewelers, that's more of a cost plus or a margin play, right? So that one you don't really look at the price, but you look at so-called that is more of a function of demand. And then for pawn shop, it's more of you look at the once the gold price goes up, they are able to give up more loans, right? So that is actually a function of price, right? So I think in that sense, obvious in explaining that, we are saying that on the way up, my personal view is that the pawn shop business should do better, in my opinion. But at the moment, our macro view is the dollar might strengthen a bit first in the first quarter in 2026. And for now, it might take a breather lah, in our view. Yeah.
Okay. Timing wise, in essence, we want to pace ourselves a bit in the pawn shop spectrum. Yeah. All right.
Yeah.
I think thank you, Peter, for coming back strongly and assisting us getting through this technical error night, but nothing short of this fantastic crowd that has been so supportive. And
Thank
yes,
you,
OSK,
everybody.
your initial is cool, and I love that OSK initial. I mean, I was always aspiring to join the other side, but I end up here, right? But yeah, let's welcome our gorgeous Warren's Queen, Isabel. And let's
Hey, but before we
give
let
Peter
Peter
a clap.
go, I want to ask him, tell me a bit about silver, Peter.
Well, silver, of course, silver and copper and all those metals, right now, is the top of the, it's really, I would say, front and center in all the interests, right? Previously was gold, and then it moved on to copper, and therefore after there was shortage, even aluminum went up. So silver right now seems to be the top of the town, and right now, in the metal space, they are starting to coin new terms that I haven't heard before, from precious metal to basic metals. Now they have strategic metals, right? So I think in the metal space, generally, there is a lot of interest, but I personally don't see fundamental demand being, silver always has fundamental demand, but I don't see it being the demand coming up as strongly. I myself, I'm not I don't have a I don't have a very strong view that it is sustained, is what I'm saying. Yeah.
All right. Thank you so
I
much.
got
I
a bad joke,
appreciate
if you
that.
guys don't mind. I got a
Oh,
really bad
yeah,
joke.
nothing can beat the pawn shop joke. So go ahead, go ahead,
Good.
There
Adrian.
will be demand for silver. Do you know why? It's a
Why,
silver
Adrian?
lining. Silver lining. Okay,
Ay.
That's
enough
pretty
of
good.
my
That's pretty
lame
good.
joke, but yeah, let's welcome Isabel.
All right, thank you so much, folks. I've got 6 minutes with you guys, so I'm gonna keep it nice and simple. Uh, I suppose we've always seen about those uh, these. There we go. Can you see my screenies? Not yet, I imagine. It's okay. I have a plan B. All right, here we go. So, for those of you who are joining me for the first time today, usually I do cover structured warrants, and my specialty isn't derivatives, but I have realized that we always focus on very high level stuff for the trader specific. So, Adrian, can you see my slides? Okay, good. So those of you, I can't see it on the Teams though. Do you mind those of you joining our presentation, can you see my slides right now? Can you see the disclaimer page? All right, solid. So for the first talk that we're doing for 2026, I just want a quick survey. Those of you who have heard about warrants, press 1. If you've never heard about warrants, press 0. Just type it in the chat for me so I know really quick about your understanding. I'm going to cover some really, really basic stuff because you know how it is in January. We always like to reset things back to the start. And this session, I'm going to do a bit of a reset. And I'm going to cover 6 ingredients you need to know about warrants and 4 common mistakes that people always make before the year really kicks off. Disclaimers, as you know, it is educational advice that I'm sharing with you now. And speaker, that is me. Current role is head of group equity marketing at Kenanga Investment Bank. But structured warrants are my baby. They're my first choice. They're my firstborn child because I was a warrants issuer just next door for about 2016 over there. I'm reading my own profile to 2024. That is 8 glorious years where we managed to make this product number 1 in the market by a massive uh, lead. So we've gotten a lot of international awards because we like to hold ourselves to an international standard. Not saying that a Malaysian standard is bad, okay, don't get me wrong, but I believe as an international warrants issuer, we need to be internationally excellent, not jago kampong, right? Licensing, as Adrian mentioned at the start just now, I am licensed, and that is the most important thing for you guys to know when it comes to trusting a speaker. For awards, the ones in red are the ones we won warrants awards for, and the rest of the awards, the ones in black, are the ones won by our entire Kenanga equity broking or equity business division. Now, quick quiz, 6 warrants ingredients. For those of you who can answer what the 6 are, I've already given hints based on the Black-Scholes or Black-Scholes pricing model. I will give you a prize, which I've not yet decided yet. 6 prizes could be quite expensive for me. I will give you something, okay? Either that or my eternal gratitude and my follow on Instagram. But can any of you name even one of these 6 warrant ingredients? Give it a shot. There's already a clue there. There's something here. Time to maturity, nice. Somebody's got that. Muhammad Akmal as well has got time to maturity. What else is there? Delta, you have Rahman. Close. It is a function of the share price. Interest rate, nice. Jonathan Ko, very good. You got one there. Come, entertain me. These are Greeks, so of course they're not the capital letter. Expiry date, close. That is time to maturity. That was this one over here, the one in orange. Time value decay, Ng Leong, nice. There is something really important in the green. Sensitivity, all right, that is something you need to look forward to when you are trading warrants based on the musty strategy. But musty strategy is a way that simplifies these things. Volatility, nice. We got volatility over there. Who was that? Was that Nick? Gearing. Okay, I mean, you guys are pretty good shot. Strike, that's the answer. Who's the one that answered strike for me? It says unknown user, I don't know your name. And mother share, SM Chow, correct. So the answers for those are underlying price, volatility, time to maturity, interest rate, dividends, and strike price. Now, for those of you who remember, there's the Black-Scholes pricing model, and that's what most issuers in Malaysia use to price the warrants. However, when you think to yourself, because I think as a warrants trader perspective, that was my previous job when I was at Affin Huang. Do these things really matter when it comes to your day-to-day trading? And so what is the question I always ask, right? Does it really help you make money? Not really, right? Exactly, Adrian. Not really. So the ones that actually help you make money would be underlying price, volatility, time to maturity, and strike price. Only those 4 on top that I put. The ones that are at the bottom, the dividends and interest rate, they affect you, especially if dividends are they are adjusted above a 2%. But if it's a normal dividend, it doesn't affect you. Interest rates don't affect you, but it is part of the Black-Scholes pricing model. Now for today, we're going to go into a bit of technical stuff really quickly because I'm going to take 1 minute of your time. I know you can't screenshot these slides, so I suppose you have to watch our YouTube replay, right? But like I said, the ones that really affect you are underlying price, time to maturity, volatility, and strike price. You can read it really quickly, but what I want you to note for, this part, you can read it on yourself later, all these bits. But the one that I wrote especially for you guys from a perspective of a warrant trader is, somebody mentioned Delta just now. UF Rahman. Now, delta is packaged under the underlying price because sensitivity is measured by delta. So deep out of the money warrants, low delta, which means it is a slow, great grand uncle warrant when it's very deep out of the money. If it's at the money, it is the highest delta that you can get. That means it's a fast reaction warrant. That's all you need to remember. Time to maturity, however, the main thing is a point on the bottom half, which I want to bring your attention to, which is time decays everything. Time decays everything, and that is even your own youth. So you need to remember that time value decay acceleration is a big component of warrants because if the warrant, let's say the underlying price is my pencil here, and this is the warrant. If the underlying price stays the same, the time value decay slowly does chip away. And when it's closer to the expiry, it just accelerates. And that's where issuers always say it's like a waterfall effect. So like I wrote, buying warrants later in life, it's like fighting gravity. You are really fighting the market every single day. And that's why you get a lot of high volume trading, you'll notice, on the Hang Seng Index warrants that are close to expiry and they have less than 1 month to expiry. So for some of you who are trading using other brokers in the market, not Kenanga's brokers, you realize that the trading platform you're using, it doesn't let you buy the warrants that have less than 1 month to expiry. Because a lot of people don't realize that last suspension date, last trading date, and expiry date are two different things. They are 2 different days, right? They are 3 days apart. However, if I was a trader, I want to have the highest effective gearing, and that is sometimes closer to time to expiry. So that's why you see high volume or high turnover on Hang Seng if you look at the entire Bursa trading for the day, because people trade intraday. They buy and sell within the same day. Now, volatility really means if the volatility is higher, you have a higher probability of finishing in the money, whether it's for calls or for puts. And issuers are allowed to expand volatility according to the vol market. And this happens when it's big news coming up, market hype, market panic. And this is where traders lose despite being right on the direction. And finally, like I said, interest rates, all right, negligible, especially for short-dated warrants. And for me, short-dated warrants are anything but 6 months. Strike price. Now, this one is really important because if a strike price is lower, the warrant price is higher. However, low price warrants are often very deep out of the money, which means they're not very sensitive to your soul. And for those of you who have attended my talks or seen the videos that I've done before, whenever a warrant is very high, offering many ticks, it means that this girlfriend you have chosen, this warrant you have chosen, she is not sensitive to your needs at all. You want her to, you're having a bad day and your face is a bit brown or black, then she'll come up to you, hey, boyfriend, how are you doing? You don't want her to totally ignore you, right? And say, like, can you take out the rubbish, do the dishes? What's wrong with your face? Right? You want somebody who's sensitive. So for warrants, you want a warrant that's sensitive as well. And dividends, we have a whole video on that. Now, 4 mistakes that I want to cover because it's 9:35. I'm doing my best. 4 mistakes that I've noticed that people always make in 2025 is for stocks, they refuse to stop loss. Number 2, for stocks and warrants as well, they refuse to take profit. So whenever you refuse to take profits and you just screenshot a position, you are actually imagining you're taking a screenshot here, but it's unrealized. And then you're just watching it come down because you don't follow the cut loss. So if something like this happens, you probably sell out over here. Or if you're smart, you see the top of the channel, then you'll sell out over here. Take profit, stop loss there. Finally, buy and hold strategy. It does work for stocks, but for structured warrants, no. You can't pass along your structured warrants to your great grandkid as a legacy. You can pass along a Patek Philippe to your grandkids. You can't pass along a structured warrant to your grandkids. And finally, double down or average down. Stocks, no. Warrants, double no. So that wraps up my quick session on 6 warrants, ingredients, and 4 mistakes that people always make. Just remember, for structured warrants at Naga Warrants, we always promote 2 strategies, which is the Musty strategy and the buy bid strategy. And finally, our Telegram channel, Naga Warrants, follow us there, our Naga Warrants issuer, where you can just message us private messages directly, and we reply as soon as humanly, physically, fingerly possible. The only thing that we won't reply within our Superman capabilities is when the market is closed and we're not working. All right, even issuers need to sleep. Our videos that we've done are in Kenanga group. There's a phenomenal stock chat. Oh, 8:30 a.m. What am I writing there? 8:30 a.m. with Adrian's Captain A stock chat. So his stock chat is rocking. Okay, I'm gonna ask Adrian to share his win rate. He's a bit shy. He doesn't like to boast so much, but as his colleague, I think he's doing exceptionally well. And after this, I'm going to ask Adrian to share. And on-ground events, they are coming soon. Let us just finalize our budget for the year. If you want on-ground events in your city, please write your city name into the chat box, and I would love to visit your city and give you a talk over there and buy you guys lunch. So, Adrian, stock chat. What is your win rate? Tell me.
All right, just to share, I mean, we have concluded 2025, and this is how we measured our so-called performance of all the ideas that we have shared in the session. For those that have joined, you have known that I've reviewed on those that did not perform and even perform. And we are running through the numbers earlier, and for those the stocks that have moved up more than 3% in a month before hitting the support 2 level, we have a 60% win rate. But if you assume that it's lesser than 3, then it will be 7.
So
70%. Yeah.
let's say if I'm a trader and I attend stock chat every Monday, 8:30 a.m. Okay, let me write for you there. 8:30. Okay. On like if it's Monday's a public holiday, then you get Tuesday, okay? But 8:30. So if I see your stock ideas and I buy every single one, for example, this is not by recommendation, by the way. We're just talking about track record. So you're telling me that out of 10 stocks, 6 of them will go above 3, and how many will go above 7% ROI in a month?
Above 7% ROI based on what I've compiled will be about closer to 50%. We did pick stocks that went up 60% in a week, in a month. And if you were to look at our stock idea for the week, which is Mr. DIY, you can actually check on the price on Monday and now. Yeah. Which is
Awesome. Thank you so much, Adrian.
Yeah.
I love your stock chats, and I hope the people over here, they would, make the efforts and attend them as well. I know Monday morning you're driving to work, but you know what? Join in, turn it on as you're driving, or maybe just get to the office a bit earlier.
There's no replay for that, yeah.
Yeah, with no replays. There are too many. All
Jay,
right.
can I come back to the 2 questions that was asked, but I didn't have the numbers just now?
Yes, please.
Yeah,
Yeah.
let's go, Peter.
TSH just now there was a gentleman who asked. So our yield is about 2.4% for 2025 and also 2026. So not really a dividend yield growth. We think it's but sustained, right? The question on TSH. So Netgate, there was a question just now. I think the question is, should we buy? Today I just checked. It was up 5%. Our target price is 115. So we think there is still some upside from here, and about 115. That's probably where there is no AI expectation in the valuations. And if you think that there is a growth in the CPU space, then that is a growth area. And also, I think there was a question on NETR. I was also thinking about within the country, how we're going to play. But let's say if you were to even think about outside of the country, in terms of like connectivity, subsea cables, one of the companies that want to enter that space is LFG, Linson Fleet. So I think that is just to supplement some of the answers that I've put in. Yeah.
Thank you so much, Peter, for getting back to us so quickly. That's Kenanga for you guys, man. And that's especially the superpower of Peter.
Peter,
Yes,
feel
Captain.
free to
Yes,
not
Captain.
sleep in the office tonight.
Okay. Yes, Isabel. Thanks for the reminders. Thanks, Captain.
So I think there's one last question from Chiu before we wrap this up is Chiu is an avid warrants trader apparently, and Chiu's broker. I couldn't identify if you're a girl or a guy, right? So yeah. How buy on a bit, but it stopped this year. I suddenly can't get. Yeah.
For me, we haven't stopped, but perhaps for some reason, maybe we missed your cue. True, no worries. My Bybit promo, it is still valid. We send them out on Telegram every single morning before 9. I wrote the link for the direct private chat. Ping us over there if you can't get it. Just message us over there. And we are more than happy to offer our Bybit promo. Whatever stocks that we mention on the Telegram are available. Status quo. 2026 will be a better year than 2025. We hope to be faster, more transparent, and more receptive to your purchases. So please do just message us if we happen to miss it.
All right. I hope that helps you out, Chu. And I guess that's wrap up the night. And before we adjourn, can we give Peter and Isabel a clap? There, I did it. Clap, clap.
It's okay. I clap for you, Adrian. I clap for Peter.
Thank you, Captain.
And lastly, a clap for all you guys. You guys are awesome and do follow us very closely because the investment environment is getting a lot more uncertain, more difficult. We need to be together as a community, and you guys are just awesome. All right. Good night.
Good night, everyone.
Bye.
Thank you.
Keep it
See you
up,
again next
folks.
quarter.